I often reminded my students that the market rewards not the man who acts first, but the man who acts at the right moment. I recall a copper campaign in the spring of 1916 when the public grew impatient, tossing orders into the pit like gamblers flipping coins. Price drifted sideways for weeks, dull as a church on Monday. But beneath that quiet surface, the composite operator was quietly absorbing every share reckless traders tossed aside. Volume dried up, spreads narrowed, and the tape told its old, familiar story. The path of least resistance was preparing to turn upward. Yet the average trader kept forcing trades, attempting to predict a move the market had not yet confirmed. I waited. Day after day, I sat on my hands while the public exhausted itself. Then came the moment, a sudden expansion of volume on an upward thrust, lifting price cleanly out of the trading range. Not a violent move, just a confident stride, the kind only smart money can produce. That was the signal that resistance had melted and demand had quietly taken control. I entered my position only then, not a day earlier. And as the advance unfolded exactly along the path the tape had whispered, I was reminded of a simple truth: timing is not prediction. Timing is listening. The market reveals its easiest path, but only to those patient enough to wait for it. I have long insisted that the market speaks with remarkable clarity to those who discipline themselves to listen, not with imagination, but with trained observation. The tape is forever telling its story, and it has no interest in flattering your opinions or confirming your forecasts. In my early years on the floor, I made the same mistake most novices make. I tried to anticipate what the market should do instead of studying what it was quietly preparing to do. It was only when I surrendered my bias and let the price and volume relationship guide me that I began to understand the principle that the path of least resistance is always visible long before the crowd recognizes it. The tape, when read correctly, tells you whether demand or supply is the dominant force, and therefore whether prices will rise more easily than they will fall, or vice versa. I remember a campaign in consolidated gas where this lesson was written across every fluctuation, yet few cared to read it. The stock had been in a broad trading range for months, and the public declared it dead. But I began to notice that on each dip toward the lower part of the range, the selling pressure diminished. Volume contracted, spreads narrowed, and the decline became sluggish, as though supply had to struggle simply to push prices a few points lower. Yet when the stock rallied, even modest buying brought wider spreads and stronger progress. I marked those behaviors carefully, for they whispered that the path of least resistance was upward, though no newspaper or tipster would have dared suggest such a thing at the time. This observation alone did not justify a trade, but it laid the foundation for every subsequent decision. The market will show you its intention through its relative ease of movement. When prices fall effortlessly, slicing through support with wide, eager volume, you are witnessing a market whose natural path is downward. When prices lift with little opposition and decline only laboriously, you are watching a market whose easiest direction is upward. These are not theories, they are mechanical readings of supply and demand, the true forces behind every fluctuation. My daily charting sessions were dedicated to capturing these nuances, where spreads expanded, where they narrowed, where volume validated the move, and where it contradicted it. Over time, this allows you to align yourself with the emerging direction instead of fighting it. A trader who buys when the path of least resistance is downward is committing an act of defiance against the entire market. He may win for a moment, but he is pushing against the current of a river that will eventually sweep him away. Conversely, a trader who waits for the tape to show that demand is asserting control is placing himself in harmony with the market's natural inclination. Every campaign I undertook, whether in steel, rails, or commodities, began with this simple question: which side finds it easier to move the market? A trading range is never a matter of chance, nor is it a period of meaningless sideways drifting as the inexperienced often believe. When I first began my studies of the great campaigns, I discovered that these quiet stretches were the very foundations upon which every major advance or decline was constructed. The public sees boredom, the seasoned operator sees preparation. Whenever a stock settles into a range, I begin the painstaking work of determining whether the composite operator is quietly gathering shares in anticipation of an upward movement or distributing his holdings before a decline. The action inside the range reveals the truth long before the final direction becomes obvious. It was during the old American campaign that this principle became cemented in my mind. For nearly 2 months, the stock oscillated between two well-defined levels, and each fluctuation said more about the intentions of the large interests than any rumor drifting across the street. I noticed that on every decline to the bottom of the range, volume expanded just enough to absorb the floating supply, but never enough to break the level with authority. The selling appeared deliberate, well controlled, as if those on the inside were testing the market to see how much stock could be taken without disturbing the equilibrium. Yet when the stock moved upward toward the higher boundary, the volume contracted, and the advance showed a certain ease and grace, as though the strong hands wished to mark the price up only enough to stir interest, but not enough to attract speculators prematurely. This interplay taught me to recognize accumulation in progress. Such a range is not drift, it is orchestration. In my daily studies, I would analyze each rally and reaction within the range, comparing the character of the volume and the spread. A rally on narrow spread and heavy volume often betrays the presence of supply, while a decline on light volume suggests that selling pressure is being absorbed. The composite operator leaves footprints in every swing. He cannot accumulate large quantities without creating subtle distortions in the tape, distortions that reveal themselves to the trained eye. Once I saw these signs appear repeatedly in American the decreasing ease of the declines and the quiet firmness of the rallies, I knew that the stock was under preparation for an advance. Though the public saw nothing but stagnation, the same principles apply in distribution, though the behavior reverses. In the Standard Railroad campaign, I remember how each rally into the upper part of the range was met with conspicuously heavy volume and wide spreads. The stock could be marked up, certainly, but only through great effort, and the moment the public absorbed the upward movement, selling descended upon it with quiet precision. That is how I knew the large interests were unloading their positions, patiently, methodically, as they have done for decades. The range was simply a container for their work. By the time the breakout finally arrived, the direction had been predetermined long before. The tape had already declared who controlled the field. My task was merely to read the evidence and prepare for the inevitable move that would soon escape the confines of that quiet battlefield. A breakout, to the untrained eye, appears as nothing more than a sudden leap above resistance or a swift plunge below support, but to the seasoned trader, it is the culmination of weeks or months of preparation revealed through countless small hints in the tape. I learned early that a trading range is not resolved by accident, it is resolved only when the dominant force, demand in the case of an upward breakout, supply in the case of a downward one, finally asserts itself with unmistakable authority. But the market does not shout, it whispers first. A true breakout is never just a price movement, it is a declaration, and I would not trust it unless confirmed by the two elements that have guided every successful campaign I ever studied: a decisive expansion of volume and a clean, confident price spread. Without those, a move beyond a boundary is no more meaningful than a man stepping 1 foot past his doorway without any intention to leave the house. During the storied campaign in Union Pacific, I watched day after day as the stock oscillated inside a range that bored most traders into indifference. But as the range matured, I observed the subtle strengthening of the rallies, the diminishing force behind the reactions, and the tightening of the lower boundary. These were the signs that demand was quietly gathering power. Then came the moment that separates the professional from the amateur, the sign of strength. The stock pushed through the upper resistance with a wide price spread, the tape printing more shares in an hour than it had in entire sessions just days before. This was not the public. This was large interests moving in unison, declaring openly what they had been preparing silently. I bought that day, not at the bottom of the range where the public dreams of buying, but precisely where the market told me the path of least resistance had shifted upward. I have witnessed the same principle in the opposite direction. In the Chicago Great Western Campaign, the range had been forming for some time, and the public imagined the stock was being accumulated. But my studies told a different story. Each rally was labored, requiring immense volume to force the price upward, and each decline carried with unusual ease. When the breakdown finally occurred, the stock slid beneath support on a wide spread accompanied by violent selling. That was the sign of weakness. I had been waiting for that moment, for the confirmation that supply, not demand, was in control. I sold short that same day, knowing that the dominant force had finally revealed itself in a visible, measurable way. A breakout without volume is a hollow gesture, easily reversed. A breakout without spread is indecision disguised as progress. But when both align, when the tape shows urgency, commitment, and authority, you are witnessing the true resolution of the range. Every campaign I undertook began with a single question at Breakout: is this movement backed by genuine force or merely an attempt to deceive the inattentive? The tape always answered, and I followed wherever it pointed, not because I wished to predict the next move, but because the market itself had already shown me which way it wished to go. The great mistake the average trader makes is believing that once the breakout appears, the opportunity has already passed. In truth, the market nearly always offers a second chance, and it is often a far superior one. I learned this through years of watching the composite operator work with patience that bordered on artistry. After a sign of strength or a sign of weakness, the stock rarely continues in a straight line. Instead, it pauses, pulls back, and tests the ground it has just conquered. This test is not noise, it is the most revealing action in the entire campaign, for it shows unmistakably whether the force behind the breakout was genuine. A test returning on light volume and narrow spread is proof that supply has been exhausted in an uptrend or that demand has evaporated in a downtrend. This, not the breakout itself, is where I have made some of my most profitable commitments. I remember this clearly during the Great Campaign in U.S. Steel. After weeks of quiet accumulation, the stock finally broke its resistance with a clean, resolute stride upward on vigorous volume. Many traders, excited by the sudden strength, rushed in as though the market were a train about to depart the station. I waited. A genuine advance does not punish the patient, it rewards them. When the stock eased back a few days later, the public panicked, believing the breakout had failed. But I watched the tape closely and noticed that the decline came on shrinking volume and shorter spreads. There was no urgency in the selling, no aggression, no pressure, only a deliberate, orderly withdrawal. This was not weakness, it was the composite operator testing for remaining supply. When the stock refused to penetrate deeply into the range and volume dwindled to a whisper, I entered at my last point of support, confident that demand was still in firm control. I have seen the same principle at play in downtrends. In the Northern Pacific Campaign, after a well-defined breakdown from a distribution range, the stock rallied sharply, almost defiantly, and the inexperienced crowd began calling for a recovery. But I knew better. The rally rose on diminishing volume, the spreads narrowing even as the price climbed. When it reached the underside of the old support, it hesitated and began to turn downward on a slight increase of activity. That was my last point of supply, proof that the composite operator was using the rally to unload additional shares. I placed my short position there, not at the breakdown, because the test offered confirmation that demand had been drained and the path of least resistance remained downward. These tests are the market's way of revealing its true condition. They strip away the noise that accompanies breakouts and breakdowns and expose the underlying balance of power. A successful test demonstrates that the force behind the initial move is still dominant. A failed test announces that the supposed strength or weakness was merely a temporary display. In every campaign I studied, and in every operation I conducted, I waited for this moment of truth. It is the point where the market stops whispering and speaks plainly to anyone disciplined enough to listen. Once a position is taken after a proper test, the work is far from finished. In truth, that is when the real campaign begins, for a trade is not merely an entry. It is a continuous study of the market's behavior as it moves through its natural phases. I learned early in my operations that the same patience required to identify the trend must be applied with equal rigor in managing the position that follows. When the path of least resistance has been unmistakably declared, the objective is to follow it until the market itself shows that the underlying force is weakening. This means watching every rally and reaction with the same alertness used to study the original range. The composite operator never reveals his entire plan at once. He advances in stages, marking up or down only as the opposing force permits. And it is in these stages, the secondary tests, the minor pullbacks, the intermediate pauses, that the trader finds opportunities to add to a winning position without undue risk. In the Great Santa Fe campaign, after establishing my initial position at the last point of support, I observed how the stock began its advance in a series of well-defined waves. Each rally carried on expanding volume and firm spread. Each reaction returned on a shrinking tide of activity. The market was telling me that demand was not only present, but increasing as the advance progressed. I added to my line on 2 of those reactions, each time only after the tape confirmed that no significant supply was entering. By pyramiding carefully, adding small increments at logical points rather than forcing size all at once, I allowed the market itself to finance my larger position. This method kept my risk controlled while giving me the benefit of the operator's broader campaign. Most traders, eager to seize quick profits, would sell too soon, satisfied with a few points. But by studying the character of each movement, I stayed with the trend long after the public had abandoned it. I managed short campaigns in much the same way. During the decline in St. Paul, once I was positioned after the last point of supply, I watched carefully how each rally behaved. A rally with narrow spread and fading volume told me the bears were still in command, and I added lightly there, letting the market confirm my judgment before committing further. When a reaction carried with wider spread and strong volume in the direction of the prevailing downtrend, it assured me that supply was still flowing freely, as long as the reactions upward remained hesitant and the declines downward remained authoritative. I held my line. I did not rely on hope or fear, but on the mechanical evidence the tape provided. Exits were never guesses but observations. A shift in the character of the reactions, an expansion of volume against the prevailing trend, or an inability of the market to progress along its former ease of movement. All these warned that the underlying power was changing hands. Only then would I begin closing my position, sometimes in stages, sometimes at once, but always in harmony with what the market displayed rather than what I wished to see. By respecting the trend, adding only when the tape justified it, and withdrawing only when the evidence demanded, I found that the market itself became a partner rather than an adversary, guiding the campaign to its natural conclusion. The entire operation, from identifying the path of least resistance to managing the final stages of a campaign, rests on one principle: the market reveals its intentions long before it makes its move. By studying the character of price and volume within the range, waiting for a decisive breakout, demanding a proper test, and then following the trend with disciplined additions and timely exits, the trader aligns himself with the forces that truly move the market. Patience, observation, and obedience to the tape form the backbone of every successful campaign, just as they did in every operation I ever studied or conducted.